Joining us not since the return of Steve Jobs have I seen anything like such excitement, because you're returning as the CEO to Colony Capital, the company that you founded.
It's like watching paint dry.
Okay, the travails of Colony after you left, and you were focused since 2014 on other things, notably one of the very early backers of President Trump. But let's talk about Colony. So what happened? Were you still involved with the day-to-day operations at all, and some of the decisions that were made that did harm Colony quite a bit, or what exactly went on?
Sure. I was still executive chairman, so eventually the responsibility all comes back on me, and the bottom line is we missed it. We had a big merger with Northstar, which was a great company. Everybody in the alternative asset business, AUM used to be the mantra. And what we had is a public REIT with an investment management toggle, so it was neither fish nor fowl. It was a REIT because it had a great dividend and contractual income on a continuing basis, but the business going forward was really using that balance sheet for third-party capital for fees and promote. And so at the merger, it was more complicated, it was more difficult. The assets were wrapped in unbelievable complexity and just took longer, and meshing the cultures, as you talk about a GE and other corporate entities, is never easy. So we got tagged a bit on assets, and it's a rebuilding mode, which is fine, because we're now at the end of a cycle, and what the end of that cycle looks like, nobody knows. But I think it's a moment to run to capital preservation, monetize, go to liquidity, keep the dividend solid, and build a balance sheet for when these markets recorrect.
Okay, at Northstar, so it's fair to say that the assets, in your view, were overvalued at the time of the merger, or did circumstances change in Europe or wherever that made things, I don't know, did things deteriorate after the merger, or did you just overpay?
Well, both. We have a gigantic healthcare business, $5 billion healthcare business. The healthcare industry changed. We had a big retail distribution business. The retail distribution business changed as a result of legal changes. And we missed the underwriting of the assets.
So, Northstar.
Yeah, with Northstar. So that's the bottom line, but it's not an irretrievable problem, right? You're dealing with 20-year assets that ebb and flow on contractual income. So the advantage of a REIT is a little bit illusory, because people always just buy it for the dividend. So it doesn't matter what you do going forward, they're buying it for the dividend. And the dividend sometimes is perceived as return on capital, but most of the time it's return of capital.
When you say recorrect of the markets, what do you mean? What's going to happen, you think, in the markets?
Well, I've probably been at it too long, so all my young guys and gals want me to leave the room, and saying it just feels as though everything is surgically priced to perfection. And if you look at the debt markets, and I think what you're going to see after these crude markets is the junk market will start to correct, the leveraged loan market will start to correct. In the buyout market, you're buying from each other at 11 times, and you're financing it at 7 times with covenant-light debt. And it's the same in the real estate market. So as everything becomes more efficient, cap rates are still contracting, because the liquidity in the marketplace is so tremendous that the risk premium is gone. That's always a dangerous place. So I think what we have is the advantage to recycle and curate assets. We have high-yielding assets. We're monetizing like crazy. We sold $1.5 billion last year. We raised almost $6 billion in outside equity. And I think when the market's correct, there'll be another intervening event which will give you a buy opportunity, but the buy opportunity is not now. So growth for REITs is an illusion.
That is very similar to what we heard from Sam Zell, who was a guest about a week or a week and a half ago, that when he looks at these markets, he's very concerned for all of those reasons, and again, because risk is being priced at zero right now.
Yeah, nobody's better than Sam. He's gotten these markets right, maybe a little longer than people think, but it's inevitable. Too much liquidity, everything's surgically priced, too efficient, everybody's put risk aside, and yet the utilization of real estate is changing. So you've talked about the retail markets, and we talked about WeWork versus Vornado, right? I mean, Vornado, one of the best real estate investment trusts in history with unbelievable bricks and mortar in New York. And WeWork that owns nothing trades at a 5 times multiple to it. It's a bizarre marketplace.
So returning to Colony, this is to clean things up. You're not going to be expanding. You're going to be making sure everything is in order with what you've already got, I guess. And I hope you didn't tell President Trump this at the midterms. He's going to be screaming at the Fed not to raise rates. If you told him that things are this dire in terms of valuation.
Well, he's screaming at the Fed anyhow, but right? Every president is screamed at the Fed.
Right.
So and the Fed.
Did you tell him that you're somewhat negative on some of these things, or?
I don't dare to tell him or give him advice on those type of things. But
Okay.
he understands it. And Steve Mnuchin is probably the best Secretary of Treasury we've had in a long, long time. So they all get it, right? It's a balancing act of where you take these markets in the future. And as the Fed stops buying long, and as the EU then follows that lead, and if Japan follows that lead, it's not interest rates are the problem. It's liquidity. And as that pulls out of the marketplace, you're going to have an issue.